Hello, ladies and gentlemen. I hope you're all doing well. Welcome to the channel. Today we're going to cover an article from Redfin as well as a forecast downgrade from Fannie Mae. In the next video, we're going to cover U.S. housing starts from the U.S. Census Bureau. But I want to cover all this today. There's so much information to unpack here. Thank you so much for tuning in, and let's begin. Okay, so this is an article from Redfin. Asking rents climbed 17% to a record high in March. And this was published April 20th, 2022 by Tim Ellis. Okay, and it goes to say rising monthly mortgage payments up 34% from a year ago, due largely to rising interest rates, are pricing more people out of the home buying market, which could lead to even more increases in rent. The median monthly asking rent in the U.S. increased 17% year over year to a record high of $1,940 in March, the largest annual jump since at least February 2020. Redfin's rental data goes back from February 2019, mind you. Meanwhile, the national median monthly mortgage payment for home buyers rose twice as fast to climb 34% year over year to $1,910, also the biggest increase in Redfin's records. The increase in monthly mortgage payments is largely because mortgage rates climbed from under 3% to 5% in just the past 3 months, pushing many potential buyers out of the for-sale market and increasing demand and prices for rentals. Even though home buyer monthly payments are rising rapidly, asking rents were still slightly higher as of March, but the gap is closing quickly and is the smallest on record in Redfin's rental data. Okay, so it goes on to say, many potential first-time home buyers are quickly being priced out of the market by record high home prices and fast increasing mortgage rates, said Redfin chief economist Daryl Fairweather. They are then faced with two options: rent or move somewhere with a lower cost of living. Those who choose to rent may save money in expensive housing markets in the near term, but long term, they may have to deal with continued rent increases year after year. Those who move and buy somewhere more affordable now will be paying considerably more than if they bought last year, but will be able to build equity in the long run and ensure relatively stable monthly housing costs going forward. So I want to go over some of this data here. So rental market summary, the median monthly rent is $1,940. It's up 2.1% month over month, year over year 16.7%. The median monthly mortgage payment for home builders with 5% down payments is $1,910. Month over month, it's up 11.6%. Year over year, 34.2%. Guys, this is crazy. And if you look on this chart here, rents are up 17% year over year, but mortgage payments are up 34%. So we kind of have a situation where mortgage rates are outpacing rents. Okay, mortgage payment increases outpace asking rent increases in 44 of the 50 largest U.S. metro areas in March. And it goes to show a chart here. The blue is the median monthly mortgage for home buyers with 5% down. The red is the median asking rent, and you can see that rents are $1,910. Pardon me, the mortgages are $1,910, whereas rents are $1,940. So we're getting close there, guys. Okay, so I want to continue on. Asking rents are up 40% in Portland, Oregon. Rent increases hit 40% year over year in Portland, Oregon, with Austin, Texas not far behind at 38%. The tri-state area and many parts of Florida also saw rental increases of 30% or more. Guys, this is insane. The top 10 metro areas with the fastest rising rents over a year. So I want to go over that. Number 1, Portland, Oregon, 40%. Austin, Texas, 38%. New York, 35%. New Brunswick, New Jersey, 35%. Newark, New Jersey, 35%. Nassau County, New York, 35%. Fort Lauderdale, Florida, 33%. Miami, Florida, 33%. West Palm Beach, 33%. And finally, Orlando, Florida, 30%. Okay, so what do? I mean, you either buy overvalued real estate or you pay inflated rents. American home buyers are in a quandary. So I want to go to this next article. This is a press release from Fannie Mae, and I found this to be quite alarming because this kind of came out after their original press release. So I wanted to kind of go over this with you. So the economic growth forecast downgraded as soft landing appears increasingly unlikely. This was dated April 19, 2022. So it goes on to say higher mortgage rate environment expected to slow housing activity. Okay, the expectations of aggressive monetary policy tightening through 2023 by the Federal Reserve are likely to further soften economic output, already being weighed down by decades-high inflation, and the ongoing effects stemming from the Russian invasion of Ukraine, according to the April 2022 commentary from the Fannie Mae Economic and Strategic Research Group. Okay. The Economic and Strategic Research Group's latest forecast includes downgrades to spot 2 and 2 spot 4 percentage points, respectively, to 2022 and 2023 real GDP growth, including an expectation of a period of modest contraction in the second half of 2023. Folks, they're calling a recession. The forecast notes that the projected downturn is not expected to resemble the severity of duration of the Great Recession due to multiple factors, including, from a housing market perspective, stronger mortgage credit quality, a far less leveraged residential real estate and mortgage finance system, and a better equipped mortgage servicer and public policy apparatus, as well as ongoing housing supply constraints relative to demographic demand for housing. So it goes on to say, we continue to see multiple drivers of economic growth through 2022, but the need to rein in inflation combined with other economic indicators such as recent inversion of the Treasury yield curve led us to meaningfully downgrade our expectations for economic growth in 2023, said Doug Duncan, Fannie Mae Senior Vice President and Chief Economist. The tight labor market and continued demand for workers, the need for firms to rebuild inventories, and the slowing of some transitory inflation impulses also suggest to us that 2022 will grow a bit faster than long-run trend growth. However, as the remaining fiscal policy stimuli fade and the predicted tightening of the monetary policy works its way through the economy, we expect the impact of these factors to diminish. Data from U.S. economic history suggests that successfully negotiating a soft landing requires monetary tightening to be preemptive rather than responsive. Folks, recession. As such, we've updated our 2023 forecast to include a modest recession, but one that we do not expect to be similar in magnitude or duration to the recession of 2008. Okay, it goes on to say, Duncan continued, we expect housing to slow over our forecast horizon as well. Mortgage rates have ratcheted up dramatically over the past few months, and historically such large movements have ended with a housing slowdown. Consequently, we expect home sales, home prices, and mortgage volume to cool over the next 2 years. In particular, we expect house price growth to decelerate to a pace more consistent with income growth and interest rates. Households with a 3% 30-year fixed-rate mortgage are unlikely to give that up in favor of a mortgage closer to 5%, and we expect this so-called lock-in effect to weigh on home sales. Moreover, if mortgage rates remain relatively elevated, we expect the added affordability constraint to price out some would-be first-time home buyers and contribute to a slowing of demand. So that is very interesting, guys. So their point is that home sellers aren't going to trade in their homes with 3% mortgages for 5 or even more. Okay, so what's the takeaway? Fannie Mae is predicting a recession in 2023. Rents are at epic proportions. Home sellers may not sell unless there are forced sales due to a recession or future job loss. And mortgage rates have outpaced rents. If you like this video, please subscribe and hit the like button. I'm a Florida, Georgia real estate broker, not a financial advisor. Thanks again, and we'll see you in the next video.